Hello, everybody. It is Sunday, July 7th, and let's see what happens. The live didn't work out so well because only a few people joined. I tried to give a little warning this time, so we'll see what happens. I have a lot of people asking me questions, so I'm hoping that it'll work into this. I have probably about 12 or 13 people asking me questions through email and stuff, so let's get on this, do a quick 20, 30 minutes, see what we can do, and we'll go from there. So again, hello everyone, and go. Anybody taking it in this week or next week? Has anyone got on recently and just taken it and kind of missed? So I'll start with a quick little thing. So here's a question for you. What is common stock? Common stock is ownership in the company. So if you have common stock, you are an equity owner. So that means but although as owner, you're the last one to get paid with dividends and if they go bankrupt. But as an owner, you have certain rights. You have the right to vote. You have the right to freely transfer your shares, buy them and sell them. Like, why that's such a good thing is that, say you want to invest in my company, my tutoring company, feel free to send checks. If you want to invest in my company, it takes weeks and lawyers and paperwork and all that. And then when you want out, it takes weeks and lawyers and paperwork and all that stuff. So the fact that you can buy IBM and then 2 minutes later sell it is a great thing. That's a true right. So we have the right to vote, which you can vote for not dividends. God, I can't believe I said that. You can vote for board of directors and major things. There's a difference between cumulative and statutory. Cumulative voting is when if you get 3 board seats, 100 shares, you get 3 votes. You get, God, what is wrong with me? So you have board of directors, 3 seats up for grabs. You have 100 shares. That means you get 100 votes for each seat. If it's cumulative, you can use those votes for any one of the 3. You can use all of them on one, do it 100 each, whatever you want. If it's statutory, you have to use it as you got them. So you're going to get 100 shares, 3 board seats. You can only vote 100 on each person. Cumulative helps the smaller investor. Okay. Now, so we have the right to vote. We have the, Reggie, I'll be with you in 1 second. The right to vote, right to receive dividends, which is great. You have the right to freely transfer. You have the right to, have a preemptive right, which means if they issue more shares, you get to maintain your percentage ownership. So if I have a preemptive right, I own 100,000 shares, say there's 1 million shares outstanding. If they issue another 1 million shares, they will give me the ability to buy more shares at a discount, like 30 days or so. It's not long. So if I get a right, what can I do? I can let it expire. I can use it or even sell it. I can use any one of those things. I can't redeem it back to the company though. Okay. So now I'm going to look at Reggie's. I think it's Reggie. Okay. From Indiana. I just can't get the options equations when I see, hey, Phil, that's awesome. I'm so happy for you. I have ADD, so I'll jump around. I just can't get the options questions. When I see questions pop up, I freeze. I know the material, but the cryptic questions confuse me. Okay, so a couple of things. One, on the SIE, I wouldn't worry about it too much. You could technically mail in the option questions and still pass. I'm not saying to do that. I'm just saying that that's what it is, that it's not really massive on the exam. So if you understand how to get break even, if you understand how to get, here's a big one. If you understand that if you're long stock, that you either buy a put or sell a call. Okay. Okay. So if you're long stock, you either buy a put so you can sell it, or you sell a call for income. Thank you, Stefan. I wanted to know what happened. So okay. So that's fine. They're going to let you do this and then take the 6. Again, my ADD. So now, if you're short stock, you buy a call or you sell a put. You buy a call to protect, you sell a put. So a couple of things real quick. I'm not going to go heavy into options because it's not that covered that much. If you're long a call or short a call, Break even is strike plus premium. It's always, whether you're long or short, it's always strike plus premium. If you're buying a put or selling a put, it's break even is always strike minus premium. Whether you're buying or selling, it's always strike minus. So let's make sure we got this. I'm not going to go heavy into it, but that's, you just get the basics of the options. If you're long stock, you buy a put to protect, sell a call for income. If you're short stock, you buy a call for protection, sell a put for income. Wait a second. So I notice that if I hear the word sell, I'm always getting income. Yeah, Stefan, give me a call Monday or so. Tell me what happened. I want to know what's going on with that. Okay, so again, if I buy a call, I'm bullish. If I buy a put, I'm bearish. If I sell a call, I'm bearish. If I sell a put, I'm bullish. I covered some of this in one of the previous ones, but I hope that helps a little bit, Reggie. But again, here's the one thing that's going to make you feel better. They're not cryptic. The questions on the actual SIE, I'm not saying they're easy. They're not easy at all. But they're not like super crazy. Okay, they're not crazy for all this stuff, okay? They're not going to go into this crazy, like, oh, you did this and that. That may happen on the top off, but not this one. Not at all. Okay, while I don't have any more questions right now, let's see. I have, thank you, Reggie. I have the right to vote, right to inspect the books and records, right to preemptive right, so if they issue more shares, I can keep it. I have the right to receive a dividend, which is either cash or product or stock, which I've covered. I have let's go with the rights on that one. Okay, so now, why do I buy common stock? Why do I buy it? Anybody? Common stock, why do I buy it? Bueller, I'm going to ignore you until I hear somebody say, what are the main reasons you buy common stock? Okay. I can do that. After somebody answers me, why you would buy common stock. That's a reason. That's not the good. That's true. But if you're not going to buy 100 shares because you can vote, because you're not really meaning anything. But that is a reason. What other reasons could I buy common stock? I'll give you one. For income, you buy it for dividends. That's a reason. Okay. Now, another reason is for growth or capital appreciation. Okay. So the whole point is that if I buy for capital appreciation, perfect, Danielle. So capital appreciation, dividends, income, and then the third one, the big one, is for inflation. Anytime you have a portfolio and it's longer than a couple of years, maybe longer than 5 years, you got to have some equity in it just to get to cover that inflation risk. Okay. So Danielle, you asked her the proceeds transaction. Is one, the questions they're going to ask you is how are the commissions charged on it? You do the commissions on the whole package, not each on its own. For some reason, it works out to be cheaper for the customer. So you base it on the whole transaction. But now let's talk about proceeds. Say you own shares of IBM and you want to own shares of Google. What you'll do is proceeds are saying sell my shares and use the proceeds to buy the other shares. So what we did is to say I have 10,000 shares of this and I want to buy stock with this. I'll sell shares of IBM and use that money to buy the Google. And then I'll sell more shares of IBM to buy more shares. So I'll go along all day long selling shares and using that money to buy. That's one way to do it. The other way to do it is you dump all of your IBM and then use that money to buy the Google right then. So let's see. So let me do this. So if IBM last sale is, of course I should have done it that way. IBM stock is now trading at 141. Let's remember that, 141. Google is trading at 1,100. So let's say ballpark, I would have to sell. I can't do math. That's why I use a calculator for everything. 1131 divided by 141. So I would have to sell 8 shares of IBM for every share to buy 1 share of Google. Okay. So I just did a little bit on options. I did a little bit. Go roll back to when I started. I spent about 5 minutes on that. And I did them in one of my Q&As. So if I had 8 shares of IBM, I would sell the 8 shares and then use that money to buy shares of Google. If I had 16 shares, I would sell 16 shares of IBM and then buy 2 shares of Google. So what we're doing is that I'm selling one and getting the money. So every share I sell of IBM, I get $141. So if I sell 8 shares, I get 1,100 or 1,200 shares. And then I use that money to buy Google, which is trading at 1,131. Does that help a little bit, Danielle? And remember, the key thing is that they're talking about the commission most of the time. What kind of commission can you charge? Because we have a 5% guideline. So that the whole point is we have a 5% guideline, and they want to make sure they're not ripping anyone off. So what they do is you sell the shares and you buy them, and then we use the combined transaction to decide if you're charging too much money. Okay. So so we know why we buy common stock. We buy it for growth. We buy it for appreciation. God, I just said the same thing. We buy it for income, and then we buy it for dividends, which is income. Okay. How often stocks pay dividend? If the board of directors declares it, they pay every quarter. Okay, Danielle, I'm happy to hear that. Now, what are the risks of owning common stock? It's the riskiest of all securities, which should mean it has the best return. It's the riskiest of all securities. So we have 2 main risks. We have systemic risk, which is the entire market. So if you own Amazon, which basically prints cash, and the market drops, it's going to go down with it. Like a falling tide sinks all boats. So if you have a market drop of 10%, most of the stocks will drop also 10%. Even if they're having a great year, it's a feeding frenzy, and they just sell everything down. So that's systemic risk. You can't diversify that away. Whether you own one stock or every company in the S&P 500, you are subject to systemic or market risk. What you could do, you could buy index puts or index options to protect it. There's other things you can do to protect it, but they're not permanent. Now, non-systemic risk or business risk is the risk that this company you have stinks. So what happens is, like, I love Tesla, but say he opens his mouth and says, oh, we can't, we're not going to deliver our shares in time. We're not going to deliver deliver the cars in time. We're missing, something came up. So that would, if you buy shares of Tesla and something bad happens, I said the SEC fines the chairman. Oh, I guess that could happen. The SEC fines the chairman, the stock may drop. And that's business risk. You have not, that's basically, you own a company and that company does something wrong or doesn't have a great month or bad quarter, whatever it is. The way to get rid of that is to diversify. So the way to get rid of non-systemic or business risk is to diversify. You could buy, you have Tesla, maybe you buy NEO, maybe you buy Google, maybe you buy Amazon, Facebook, IBM, Gillette. You buy a bunch of stuff. Maybe you buy NVIDIA, which Kramer loves. You do all these different companies. Maybe you buy a couple of JP Morgan, some banks. You spread the risk out. And then even if one company does bad, the other ones should be okay and not make you lose money. Okay, what products instantly diversify you? I'm going to give you guys a chance. What products instantly diversify you? And if you guys have questions, interrupt me. I'm just kind of riffing because I can. So what kind of products instantly diversify you? Basically, you buy it and you are diversified. Good. ETFs and mutual funds, package products. ETFs, mutual funds. Obviously, nobody answered. I'm just being obnoxious. ETFs, mutual funds, variable annuities, closed-end funds, technically variable life insurance, anything that puts like a package product where you're buying multiple shares of something at the same time. So mutual funds, remember, so why would you buy a mutual fund? One is for diversification, one is for professional management, and another is for liquidity, which I've covered before. So again, to get rid of non-systemic risk, I diversify. So I buy mutual funds, ETFs, closed-end funds, variable annuities, anything that puts me in a bunch of stuff, or I just go around and I buy a bunch of different securities. Okay. So another thing that confuses people is preferred stock. Preferred stock is only called preferred because you cannot pay the common a dividend until the preferred is paid. That's the only reason it's preferred. It's kind of cool that it pays an income, but that's all it does. It doesn't have voting rights. It doesn't have preemptive rights. If they do a stock split, you don't get any more. It doesn't have anything. All it does is pay a fixed dividend. So even if the company, say you have a 4% preferred, par is $100, 4% means you're getting $4 a year, which is $1 every quarter because they pay every quarter. Say the company cures baldness and obesity in men. All about me. That company, the earnings would skyrocket. And what are you going to get? Still $4. Nothing changes. Where the common stock, you have the risk of a changing dividend, but it could skyrocket and then you're in good shape. Okay. So we have preferred stock gets a fixed dividend. It doesn't change. So you're buying it for income. That's what you're buying it for. It doesn't have voting rights. It doesn't have any rights other than to receive a cash dividend. So it's pretty boring. The other thing is, since it's technically a fixed income security, it has interest rate risk. It has reinvestment risk, which I've covered in other things. It has call risk. But it moves in inverse relationship to interest rates. And again, preferred stock is equity, but it acts a lot more like a debt than it does a common stock. What are the different types of preferreds? We have regular preferred, which just means it lasts forever. You're going to get paid every quarter forever until they call it. We have non-callable preferred, which means they can't call it. We have cumulative preferred. So remember I said, good, convertible is one of them. So one of them is, so cumulative, remember I said you can't pay the common unless the preferred is paid up. So what happens is the preferred, good, the preferred, if you pay in 2018, and say you don't pay anything in 2018, come 2019, you have a clean slate. You can just start paying again and not worry about last year. People will be mad, but it's doable. If it's cumulative, you have to pay all the past dividends and this year's before you can pay 1 penny to the common. So cumulative is a little safer for the preferred owner because they have to pay all the past ones back. Okay. Danielle, you mentioned participating. So before I said, if you have a 4% preferred and the company cures baldness and obesity in men, then the earnings will go up like crazy, but you're only getting 4. So they created a thing called participating preferred, where participating preferred, actually they do this. They pay you your 4%, then they pay the common, and then they come back and pay the participating an extra little bonus. So if you can sort of participate in the earnings growth of a company. So we have regular preferred, we have cumulative, which pays all the packed dividends. We have participating, which means if we have a good year, we'll give you more. And then we have the last one, which is convertible. We do have one more after that. Convertible means you can turn it into stock whenever you want. There's a whole convertible ratio. But the point is, when you buy a convertible preferred, at any time, you can turn it into common stock. Since it turns into common stock, it's very volatile because it'll always trade correlated or with the common stock. So if the common stock goes up 10%, the convertible preferred will go up 10%. So even if all of the preferreds, interest rates drive the price. If in a convertible, the market price of the stock drives the price, so it's more volatile. So if you buy a convertible, not only do you get the income, you also get the capital growth, capital appreciation, capital growth possibility. So you get both income and growth, which is kind of nice. So since they offer extra features, the coupon they issue out will be lower because there's lower risk. So if you have a regular straight non-callable preferred, it's the highest coupon. If they make it callable, it's lower. If it's convertible or participating or cumulative, it's going to be a lower coupon because there's less risk to you, the investor. Now, there's also a variable rate preferred, which just means if you have a 4% preferred and rates go up to 8, it's going to go to 8. If rates go to 4, it's going to go to 4. To 6, 6. It stays with it. So it's not very volatile because the price won't change because it's always basically keeping pace with the current interest rates. I like that. Okay. Okay. So now, the risks of preferred are, I'm going to go just through them. It's like it's basically the same as debt. Interest rate risk, reinvestment risk, call risk, inflation risk, and reinvestment risk. It doesn't really have default risk, but it does have business risk that if the company doesn't pay. But it's not default because default is only for debt. It's like default. Okay. Now, Reggie, yes, the SIE is not as cryptic as Kaplan. If you know your stuff, you will be fine. Kaplan's questions are trying to screw you up. The SIE is not as cryptic. Okay? They are not trying to trick you. Yes, the questions are not easy. I'm not saying they're easy, but they are more straightforward. Like you may get a question, but the 4 answers may be a little bit skewy, like not perfect. But Kaplan is definitely harder, not always in a good way, but harder than the exam. And the style of question, as you've seen, that if you, right. So Kaplan tries to trick you. And what happens is then you take the test and you think they're trying to trick you when they're not. So Kaplan questions are a little trickier and they don't look anything like the exam. I'm not saying SEC does look like the exam, but they're a little more straightforward. They still try to trick you, but they're a little more straightforward than Kaplan is. Look, you can pass with both. Don't think, oh my God, I have to get SEC. If you have a friend who can lend it to you, I'm not telling you to rule that, to violate copyright or anything, but if you have a friend that can lend you the STC book, or if you have STC, friend can lend you the Kaplan book, it's fine. I think the law catch up, but right now, STC is a little bit ahead of the game on the rest of them right now. They seem to have nailed it. Kaplan, Notman, pass perfect. They're all fine. You'll pass. But I think STC has done a little bit better. Okay, basketball, and give me a second. So now, special settlement. Okay, so regular way settlement is always T+2. That means if you buy stock on Monday, it settles on Wednesday. If you do next day, it settles tomorrow. And what settlement means is really that's when you become an official owner of the company, because say you have Schwab as your broker-dealer and you buy shares on Monday. On Wednesday, Schwab will send the money to the other person who sold it to you, and the person who sold it to you will send it to you. That all happens on Wednesday. Okay? Now, you have to pay for it. You have 4 days to pay for it. So if you buy stock on Monday, it settles on Wednesday. You have until Friday to actually put the money in. So they're kind of lending you money for a couple of days. That's regular way settlement. Next day, it means they settle the next day. The next day, like you buy it on Monday, all the money changes hands on Tuesday. Now, a special settlement is just that I'm going to settle later. They have a thing called seller's option, where seller's option is like I'm going to sell my stock, okay? But I don't know if I have it yet. Maybe it's caught up in escrow or something like that. And I don't know when I'm going to have it, but I want to sell it now. So I sell it now with seller's option listed on there, so whoever's buying it knows that that's what it is. And then anytime up to 35 days. So I have up to 35 days, no less than 2, between 3 and 35 days. When I get the shares, I deliver them. If it's going to be more than 35 days, I'll probably have to mark it short because I have to get a borrow, because you can't hold it open that long. But again, seller's option is pretty much just, look, I'm going to sell it, but I don't know when I'm going to settle. So I'm just going to, I don't know when it's going to happen. I don't know when I'm going to have the shares. So I'm just telling you seller's option. It's up to me as a seller when I do it. I will have to give you 1 day warning that I'm going to settle, but that's kind of what it is. Special settlements are just basically the ones not regular way. So regular way is T+2. I can do cash settlement. I settle today, which means I buy the shares on Monday morning. By Tuesday, by 2:30 in the afternoon, I've settled. which means that so you're becoming an owner that day. Now, okay, basketball and Trey. You're new to everything, so you want to know where to start. Okay, so the first thing I tell everyone is read the damn book. Read the damn book. Look at Investopedia. Google everything as you're doing it. Watch my videos. I think they help. Okay, I think they help. My wife probably disagreed because she thinks I'm an idiot when I do this, but that's fine. So you can also hire me as a tutor, but whatever. So the point is, read the book. If you have STC, Kaplan, Past Perfect, or even Notman, they're all probably okay. If you have the other ones like AD Banker, Exam FX, or Past the SIE with Robert Walker, I don't know much about them, or Solomon. Not huge fans, but it doesn't mean they're not going to pass. You can pass with those things. I just think right now STC is kind of beating everyone. And the thing is, they can't print new ones, obviously, until the fall. So come fall, they'll probably all even out. That doesn't help you very much in July. But for right now, I think that if you can get STC books and their whole website, that's better. If you're self-teaching by using like free stuff, it's a little tough. You're gonna have to drop cash on this somewhere. And if you're gonna drop cash for the first time and they give you a choice, it should be STC. Okay. 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 So I hope that helps, Basketball Trey. I'm shortening your name. I'm too lazy to write the whole basketball in. So really, if you're gonna get started, read the book. Okay. Now, John, for each transaction, a customer must be sent or given a written confirmation of the trade at or before the completion. So basically, okay, I'm going to answer this real quick. Sean, Exam FX, I don't know much about them. Not a big fan. Okay, I don't think they cover everything. Again, my biggest thing is STC, Kaplan, Notman, Past Perfect. Even Securities Institute of America, I'm actually okay with. They're on the cheaper end. They'll give you just enough. They give you just enough to get under it. Also, Training Consultants is okay if you get that. Their videos are good. Look, I know my voice is annoying. The girl Tina's voice is really annoying, but she gives good info, so you got to deal with it. And if she talks really slow, I tell everyone to turn it half speed, like half speed on your video, so it comes in better. Okay, John Lim, for each transaction, a customer is sent or given a written confirmation. A confirmation is if you buy 100 shares at 50, the confirm has to be sent to the customer saying, okay, you bought 100 shares at 50, this is what you paid, this is what the commission is, this is your account, this is how many shares you have. It's a confirmation of the trade. It's going to say whether it's an agency or principal transaction. That must be sent to the customer before settlement. Settlement is completion of the trade. So if I buy stock on Monday, it settles on Wednesday. That is when it settles, it is done, it is completed. The confirmation has to be in his hands or her hands by that day. I hope that helps, John. Okay. Eurodollar bonds, Euro bonds, Yankee bonds, ADRs. Okay, so carve out ADRs. They shouldn't be in this list, but an ADR is when, and I think I covered it, an ADR is when a foreign security like British Petroleum, you want to buy shares of that, but you don't want to put it, you don't want to go to Europe and open an account in London, okay? So now, you're going to open an account here. Deutsche Bank goes and buys like a bunch of British Petroleum and then packages it into this like package. They put the shares of British Petroleum in here, like maybe 5 or 10 shares. Then this thing will trade on the exchange. You'll be buying shares of the glass of this thing that is holding the ADR to British Petroleum. Okay, that is an ADR. This is a foreign security trading in the U.S. Now, Eurodollar bonds, Euro bonds. Eurodollar bond is a bond like Apple issues as a bond in London. Apple issues God, I sound like an idiot. Issues a bond in London. It is paid in U.S. dollars. The interest is in U.S. dollars. You buy it in U.S. dollars, so it's a Eurodollar bond. That is a Eurodollar bond. It is a U.S. company issuing a bond in another country denominated in U.S. currency. A Euro bond is sort of the same thing, but not the U.S. A euro bond is like if a Japanese company issued a bond in Germany, but it was denominated in yen. That's a euro bond. Euro dollar is U.S. company issued in another country, denominated in dollars. A euro bond is a a Japanese company issuing a bond in like Germany, paid for in yen. Okay, so now a Yankee bond is a foreign company issuing a bond in the U.S., like in the Yankees, paid in dollars. So it's like Samsung issued a bond in the U.S. That's a Yankee bond. Now the one that you may not know is a euro dollar. So euro dollar bond is a bond. Euro bond is a bond. Euro dollars are U.S. dollars denominated in a foreign bank. So it's deposited and in a foreign bank, but kept as dollars. Like if you go abroad for college, or you go abroad and you have like $1 million, ooh, we wish. You had $1 million in cash. You deposit it in the Bank of Rome. And you tell them, don't you change it into euros or lira. Not that there is anymore. I want you to keep it in dollars. So euro dollars are U.S. currency deposited in a foreign bank. Okay. CUSIP, John, a CUSIP number is just an identification number for stock. Every security, like IBM has a CUSIP number. Intel has a CUSIP number. Google has a CUSIP number. Not each certificate that you own, but the entire company they have their own CUSIP. It's just an identification thing. That's all it is. Okay. Did that help, Danielle, or did I ramble too much? Okay, so now, if you invest in another country, this is a question. If it's not on this, it'll be on the top off. Sometimes any money that you make, if you make money, they may withhold cash. That's them withholding taxes, like your paycheck. You may say your paycheck is $1,000. We're going to withhold 200 of it, and you're getting 800. Okay, that's withholding. If any investment you make in a foreign country, they might withhold some of the money. That is to pay their taxes. You will get a credit again with the IRS for that. The IRS will give you a credit. You will get a credit against your IRS thing. So, John, we are about to deduct it here at home. So, what happens is, say you have $1,000 and you make $1,000 investing in another country. They're going to withhold $200. Then you get here and you file your taxes and you realize you owe $400 on that profit. Well, the IRS goes, oh, well, you already paid $200 to London, so you only do this. You only have to pay $200. Okay. Okay, guys. I can go another 5 minutes, and then I do have to go because I do have some work to do. I can do another 5 minutes, and at worst, you can just sit there and re-listen to my rambling. Look, John, I'm happy to do it. I make a good living teaching and tutoring, so I'm trying to give a little back. I make a lot of my money on the top off stuff, and the goal is really maybe I can do this permanent, because if I get enough followers, that's why I want you to share this stuff. If I get enough followers, I can put ads on this without charging you guys anything, and I can make money on this. I'm pretty selfless. I'm doing this, and it may never work, but maybe I can make a little money in the back end without hurting you guys at all. And then you guys get free information. I think I covered most of the questions. And if you guys ever want to bring me in and do something where I can do come in and teach a class or something like that, I'm happy to do it. I do it all the time. Like I just came back from Michigan, so I do a couple of things all the time. But this I'm going to try to do more and more. I just get tired from teaching all day, and I don't want to do it. So let's do this. Let's kill it now. And I'm going to try to do another one on Wednesday. I say that and I don't always do it, but I'm trying to do another one on Wednesday. I guess might be doing that little 3-minute video. Warned you guys enough. So here's my question for you. Hey, you're welcome, Allie. So here's my question. Do you guys get a notification that I'm doing this? That's what I need to know. So if you guys don't get notifications, I don't know what to do because I don't know how to get you to do it. So that's why I did a little 3-second video at like 4 o'clock that tells you I'm doing it so you're warning. Okay, perfect. So that's what I'm saying. If you share it to anyone, tell them to subscribe. Okay, awesome. So Danielle, so hopefully this one. Okay, so John, maybe turn on subscribe, turn on notifications. I worked one of my students today. He was you have to subscribe, and I think you have to turn on notifications. That's what I did with someone. But I'm still learning this, and I'm trying to do it, and I'm trying to help everyone out. Okay. Listen, all have a good night. Keep reading, and we will go from there. Have a good night, y'all. Yeah, I'm not Southern. I just say y'all because I heard them saying it on the Today Show. Okay. Oh, perfect. So, and also you can watch this again. Happy to help, basketball. You all have a good night. No problem. Bye-bye.